All right, my friends, happy Thursday. Good afternoon, good evening, good morning. We have some things to talk about. We've got the market was, generally terrible today. Stock market didn't do anything very good. A couple of tech stocks are up. Netflix is up because I think they just signed up the rest of the world. So there was a few people they hadn't gotten to subscribe, somewhere in maybe, I don't know, Congo or something. But now officially the whole planet is on Netflix. So their stock's up a bunch. But a lot of other stocks are down. A lot of stocks are down. So oftentimes it's a little shaky going into a new presidential administration. Sometimes it takes politicians a long time to ruin the economy, and sometimes it takes them a very short amount of time. So we'll see how this one goes. But what I want to talk about is how the market, how we can trade the market, how we can kind of react to some of this stuff that is happening, and what we can do about it. So I'm pretty excited for that. So we're going to discuss those details, and we'll get right over to the charts and have a little peek. That sounds good to everybody. Okay. All right. So here's some current positions, but I want to talk a little bit more kind of specifically, and then we'll look at some positions and kind of how everything's going there. But I want to kind of talk about what we may need to do, what we might have to do to kind of, trade some of these bearish situations, how we can kind of take advantage of, of a downturn and a couple of different kind of options and things that we can do there. Does anybody have any questions or comments before we get started? Any thoughts you want to bring up? Any things you want to kind of talk about here? Anything at all? Anything at all? If you do, just type them in. If it's totally unrelated to what I'm talking about, I might wait till the end to answer that. But if you have any, just thoughts, questions you want to bring up, go ahead. Go ahead. Okay, guys. So what we're going to discuss, remember, our strategy, has worked out very super well. It's worked out incredibly well, right? Everything is a bull put spread, and eventually turns into a naked put, and eventually turns into owning stock, and eventually turns into a covered call. Boom, 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 boom. Love it all. So great. Everything's very good. This has worked out so well for us that we haven't taken a loss on a single trade that we've done in the group with this strategy. That's pretty good. We'll take that. 100% success is pretty good in my book. However, what are we going to do about markets that start to kind of, go on these semi-big-ish, sort of big-ish downturns, or just kind of start to correct on us and start to go a little bit the other direction? Because remember, this whole strategy right here is a bullish. Hold on, what's this? Is this the paragraph? Oh, boom! Is that the paragraph symbol or whatever? I don't know. I just remember I had a flashback to school where they would always say, bad grammar or whatever. But anyway, this strategy is certainly a bullish strategy, right? This is betting on the fact that stocks will go up over time, which I still think they will, and they can, and they should. But it does get a little tiny bit trickier when we have this kind of a strategy and a long-term downward moving market. Now, do we think we have a long-term downward moving market? I don't think so. But maybe. And I think there's some sectors that are going to hate life a little bit. But for a slightly longer downward market, there's going to be some things we'll discuss. For a shorter correction, which I think we're probably going to see a bit of, this strategy will work well, but we need to have some tweaks on it. So let's kind of just talk about everything there. That's a lot of stuff that I want to discuss. Let's see here. Mel, does this always work? Pretty much yes. Yeah, I mean, it does. It really does. But it has to work with some of the tweaks that we're going to discuss. Ray, how does vertical spread not benefit from a down market? Vertical spread can. You can trade a bearish call spread. I like to trade those pretty much never. And so I think there's a better way to trade a bearish market than a bearish call spread. It's a funny thing that, I'm such a diehard bull put spread, credit spread trader, and it's been so good for us. And a bear call spread, a short call vertical, whatever you want to call it, is just the exact opposite. You think it would be as good, but it's really not as good. It's really terrible, actually, because we can't close part of our trade off. We can, but it's the fear of assignment and being naked short, some call options, being short a stock that we don't think maybe is going to go down. These are all really risky scenarios to be in. The bullish side, these are all really safe scenarios to be in. So, I don't do call spreads much. There might be a time where we say, yeah, we'll do a call spread. But pretty much if we do a call spread, we're going to have to say, okay, if I'm making $50 a contract and I'm risking $50 a contract, I have to take the loss if it doesn't work. With our bull put spread, we don't ever have to take the loss. We own the stock, right? And so that's kind of the other side of things. Yeah, so Ray, these are all vertical credit spreads. Bullish strategy, that's a vertical credit spread. A call spread's a vertical. They're all vertical credit spreads. But a bullish. So if this is what you're asking, Ray, it's a good question. It's a good point. A bullish put spread does protect us from downside, but if it's a long downward moving market, then it's not the most effective. We can still survive it. We can still come out okay, but it's maybe not the best way to trade it, right? If we have a downtrend on a stock that goes for 3 or 4 or 5 months, then at some point we're going to run out of expiration. We're either going to have to take the loss on our bullish put spread, or we're going to have to own the stock. We're going to have to own a stock that is continuing to drop, right? So it is a good strategy for that, but it's not it's not good if a stock is really trending down. So I'm going to talk about the 2 things that we need to do for stocks that are, correcting, and for stocks that might be in long-term downtrends, right? So let's talk about what those are. First of all, with our homegrown strategy here of just, going through these steps and doing all these wonderful things, this is all okay and fine and good. Basically, all we have to look for, the thing that's getting my attention a huge amount, and I've talked about this quite a bit, right, is the spaces that we're starting to see between price and moving averages. These things are indications for us. They're signals that, that corrections can and likely are coming and likely will happen. The 2 things that I look for, and we've talked about this quite a bit in past webinars, is I look for the space between price and the 50 and price and the 200 moving average. Those are 2 pretty important areas to watch. And so if we look at that here, let's do a little duplicate the bubble here. If we look at this and we say, okay, price and the 50 and price and the 200, if we look at these and we say, okay, that's a lot of space and that's a lot of space, and we start to kind of, go back and we look at these, right? And we say, okay, whoops, what are some conditions where this has happened again in the past? We saw a pretty good gap right here and, continued higher, right? Pretty good gap right there for price and the 50, made a run higher. But we see that whenever we start to see this stuff happen, we get, sometimes weeks and sometimes months of sideways and even small movements. But basically 100% of the time, the bigger that gap gets, the more likely we're coming into big corrections and big pullbacks, right? This was kind of September, early September. SPY was way up here, big gap between price and the moving average. And same thing, big gap between price and the 50 and the 200. Both of these were, were big spaces, big situations right there. And so when I saw those, I always start to get a little cautious. I always start to get a little bit careful and say, okay, guys, we can start to see these kinds of corrections, right? This isn't like panic market correction. This is kind of, a little panicky and then a little kind of sell-off. If there's one thing that the market's doing is it's reacting a little more quickly and a little more aggressively, right? So we get these kind of big swings up and down. We get pretty aggressive recoveries and we get pretty aggressive sell-offs. So when we had that big space on SPY over here, we saw a pretty aggressive sell-off that went, into just about the 50 or the 200 moving average down here, but then it pulled back pretty quickly, double bottomed, and worked its way back up again. So we're kind of in that same situation, right? We're back over here, and I'm starting to think to myself, okay, I'm feeling a little nervous. I don't know if the market is, going to pull back really aggressively, or if it's going to, I mean, the longer this gets dragged out, the more aggressive the corrections tend to be. So we're starting to see this in a lot of different sectors. If we go to, a lot of things that have been up in the past, right? We've talked about some of these examples, Tesla, right? Tesla is the stock that never seems to be able to slow down and come back. But, these big spaces and these big gaps happen, and, we get consolidation. Bigger spaces, bigger gaps. We start to get those corrections. That was a pretty big correction. That corrected from 500 to about 300. That was almost a 50% pullback on the entire value of the stock. Now here we are again with Tesla, right? Tesla is a bad example of a stock anybody should ever short. You should never short Tesla. Just don't ever do it. But big space between price and the 50 moving average, and even bigger space between price and the 200 moving average. So these are getting to points of consolidation and points of correction, right? So in consolidation type situations, we can do just fine with our strategy. And some of these stocks are very intent on moving higher. So a consolidated strategy, we're fine to do exactly what we do, which is go out about 2 weeks on a bullish put spread, take assignment, sell a call option and be done with the trade. On these that, tend to, Tesla is probably, Tesla and like Apple and Amazon are some of the ones that just tend to go higher, right? Amazon had some big spaces here, but they started to, Amazon started to kind of fill those gaps and big pullback, right? Big space, big pullback, again, big space, pretty big pullback. So we started looking at that stuff. And by the way, on the currency side of things, I look at this as well. This is very, very important in currencies, in stock and options and everything. So, sometimes there's a big correction. That was a decent sized correction. The stock went from $3,500 all the way down to, $2,800, right? But it's up over here a little bit, and it's kind of making some recoveries and so on. But it's basically Amazon topped out in August of last year, and it's done nothing since, right? And so when we get these big spaces, this is a very common situation of get stuck in a sideways channel like this, or have a semi-violent correction, right? And so those are the things that we kind of have to watch for. We've seen, these kinds of things happen before, and Apple, kind of did the same thing, right? Big spaces, big gaps. We got a big pullback, this was all the way up at 137, pulled all the way back to about 105. That's a 30%, 25, 30% pullback there. And we're starting to get kind of into that situation again. Now, Apple, and we don't even trade Apple, so we don't really care too much, but Apple is, pretty far from the moving average. But it's just coming off of, pulling back to these shorter term moving averages. So it's kind of saying, balanced out a little bit. At some point it's going to get pretty overextended. We've got a big triple top here that's been a struggle. But at some point, this is going to get fairly overextended. And these things typically happen when we have a lot of distance. Again, this is pretty important here. We have a lot of distance between price and the 200 moving average, but we also, in this case right here, have a lot of distance between price and the 50 moving average, right? These shorter term quicker moving averages here, we want to keep an eye. Made it too small, now I can't move it. We kind of want to keep an eye on those guys too, right? When we start getting that big space between that black line right there and price, that's where those pullbacks get aggressive. This isn't too far off the black line. It's a little bit off that, but that's a 50 exponential moving average, and this is a 200 exponential moving average. So the bigger those distances get, the more at risk we become. So when we look at some of these trades, we've been trading airline stocks quite a bit and doing some of this. We don't quite have that same, really scary kind of gap on some of these, right? Southwest is a little bit off the moving average, but it's, I would say that this is not an overextended stock by any means. In fact, this is a slow recovering stock, right? We talked about the banking stocks a lot. Look what Bank of America's done. Bank of America got real aggressive here. We have traded Bank of America multiple times. I haven't been in it for a couple of weeks, but look what's happening. Bank of America is now getting off that shorter term 50 moving average, that black line, and it's getting pretty darn far from this guy right here, which is our 200 moving average. So what's Bank of America doing? It got some pretty good distance there, and now it's pulling back, right? Now, some of you might be thinking, and some of the more technical folk out there, I know we've got some engineers in the group and some math people and some, attorneys and so on, some real analytical minds. You might be thinking, well, how far is too far? And basically what I like to look at is, I like the principle of it, right? I like the principle of, a big distance away from the moving average. Every stock's different, right? Tesla is going to move further away from those moving averages than Bank of America will, right? And so we just kind of have to look back over the last year or two and say, what kind of gaps does this thing make between price and moving averages before it tends to pull back, right? What kind of gaps do we get? If we look at Bank of America over here, oftentimes these big things, these big corrections, these big pullbacks happen as we get a lot of space, right? That right there, this was before Corona Town. This was December 2019. And we were getting pretty high up there away from that 50 moving average, right? We started to get some pretty good gaps and we had a bit of a sell-off, right? Didn't hit the 200 moving average. But by the time, the coronavirus stuff hit, we were still a bit away from the moving average. Now, this isn't the case with everything, right? But we are usually seeing some pretty good gaps before this consolidation or sometimes violent corrections happen, right? So how do we trade that? How do we, how do we manage that? In the group right now, we have some trades on these kinds of stock, right? We have a trade on US Steel. It was up a whole bunch. It's down a bit now. And we're seeing this kind of thing, right? We're seeing, okay, and we talked about this in the group. We said, okay, we're in a pretty big gap here. We've got a pretty big gap. And what happens? This thing pulls back. And I think this is around where we got a sign somewhere in here in this pullback. We got in over here, it dipped down on us. We got a sign, and then we rode it up a bunch. But, it still never really kind of reset those gaps. And so what do we have here? We have on this one, we had a pretty big space here between price and the moving average. It hit a big resistance level. We always have to keep an eye on those support and resistance levels. And we hit a big resistance level, right? This has been support over here, resistance over here. It hit that, and it also had kind of the perfect storm of big gaps, right? Big gaps between price and moving average. So is this coming back down to kind of hit some of these moving averages and reset? Probably what it's going to do. And it's still got a pretty big space between price and the 200 moving average, right? It's closing in on it, but these are things that we want to keep an eye on. So what do we do on these trades? We can do one of two things. Number one, if we like the stock, US Steel, in my opinion, I like the stock a lot, right? The stock has been coming, and this is where kind of this analysis and how we trade this market that's kind of a little bit extended, this is how we do it, right? We look at US Steel and we say, okay, US Steel doesn't tend to go, too much below kind of this area down here, right? I'm looking all the way back to 2003 and even beyond that. This thing going back 20, 25 years doesn't tend to go too much below $10, right? And we see it up here at about 20 bucks. But how high does US Steel go? We've seen it up in $200. We've seen it do a lot of movement up here in the 45s and 50s, right? And so I like to look at stocks as all these charts have a little bit of muscle memory, so to speak, right? And that muscle memory tells us we've had some extremes up here. We've had a few little extremes down here. But I think that a stock like this is a little more comfortable, probably in the $40 to $50 range, right? And so here we are down at 20. So are we going to be panicked by every little pullback? No, because we have a bigger picture that looks really good here. Looks really, really good. It's coming off these big lows that have held this entire time. So we want to see that going up. And the reason I'm kind of talking about this is to give us a little bit of context to what we need to look for. If that is the case with a stock that you're trading, then here's how you should plan your trade. With a big drink of water. You should plan your trade with our typical strategy. Credit spread, bullish put spread, Let's get assigned if it goes down. Let's sell a covered call on it. Let's do all that stuff. But we have one of two things that we need to do. Number one, we need to either wait for a little bit of pullback, or number two, just go with a longer expiration, right? So I'm typically selling a 2-week expiration on my typical credit spread. I'm going out 2 weeks, fine, no problem, everything's good. So what I'll do is I'll just go a little bit further out, 3 to 4 weeks, right? Give myself a little bit more time. If I say, look, this trend is great, I don't want to miss out on it. In the worst case scenario, I want to be able to make, my credit spread profit of, $50 a contract or whatever. So I'll put the trade on, but the further away it is from these moving averages, the more likely we are to see it pull back, right? So when that does pull back, the longer we have on our expiration, if we go out a month or a month and a half or whatever, the longer we have on that expiration, the more protection we have as that pulls back, right? And it dips down into those bigger levels. So number one, you can simply wait for pull back, right? Number two, use longer expiration. Now I have a number three, and we're going to talk about that. And this is certainly the most risky of them all. But our main kind of go-to way is, wait for a pullback, right? Use that longer expiration. If you see something up here, you can say, well, maybe I'll just wait till this thing comes back a little bit. We might end up missing the trade, and that's why I tend to lean towards just a longer expiration instead of the pullback. Because a pullback's fine for us. With this strategy, a pullback is just fine. We're totally good with that. We have no problem. Because if this thing, if we have a credit spread on that has a month expiration and a stock drops 50%, that's fine. We don't care. That's okay. We'll just own the stock with, a heck of a lot of profit from that long put, bringing our break even down to pretty much where the current stock price is trading. So that's okay. I'm okay with all that stuff. But we need to watch for these spaces. We need to wait for those pullbacks or use longer expirations. Now, option three in this kind of a situation, there's actually 4 things to do. Option three could be, and is, and we're doing this in the group, trade, VIX ETF long, right? Something that tracks the VIX long, right? That's just the other trade you can do. You can throw on there. If the VIX is low like it is right now and stocks look like they're getting a little bit overbought like they look right now, you should be long something the ETF. We have a VIXY trade. So some of these are inverse. You got to be very, very careful. VIXY is regular. VXX, I think, is regular. UVXY, I think, is inverse. So you got to know which ones these are, right? And that'll be super important. But find something that tracks the VIX long and buy shares of that, right? Find something that's cheap. We're trading the VIXY and it's trading at 1350 or so right now. So we have some shares of that, and that's going to be a great way to just benefit. I mean, you can just hold on to some of those trades while the market looks incredibly overbought, and have some shares of that ETF, and that will make up for a big chunk of market pullbacks, right? We see some volatility and some things happen there. Number 4 is we can buy a put option. Now, this is my least favorite of all, right? And it's not my least favorite of all for me, although it is a little bit, but it's my least favorite of all for everybody, right? Because all I see happen with people that buy options, and this isn't 100% of the time, it's maybe like 90% of the time, people lose money buying options, right? If you buy a put option because you're worried about the market and the market doesn't go down, then your put option goes to 0, and that's a bummer. You buy a call option because you're really bullish the market and the market doesn't go up and you lose money, and that's a bummer. With our strategy, if the market doesn't go down, we make a little bit of money. If the market does go down, we usually make a lot more money. Great, it's awesome. But when we're buying call options and buying put options, it's a tricky situation. We've got time decay we're dealing with. We've got, how fast can the market move? We've got all these kinds of situations. So here are a couple of things, and I'm going to incorporate very small amounts of this into the trade group. We're doing all of this already, right? But we'll do a little bit of this possibly in very light doses, and I'm going to show you how we're going to do this. before I get to all that, does anybody have any questions? Do these spaces make sense? Do longer expirations make sense? Do waiting for pullbacks and having some VIX trades and all that stuff? Is everybody, you guys good with that? That sound good to everyone so far? What do you guys think about all that? Does anybody have any questions? Questions, comments? If you don't, that's okay. But I want to give everyone a chance to kind of catch up, ask any questions. Typically when I say this, I forget that it takes people a second to type, and then I'll start talking again and then questions pop up. But you guys all feeling good? Following along okay? Everything doing all right? Okay, good. Good, Dale. Good, good. All right, all right. Okay, so let's move on to some things we can do with put options. Again, I don't love put options. I don't love them much because, you know, I just have this old-fashioned, you know, stocks tend to go higher, everything, you know, kind of goes up, and I don't always love betting against the market. But when we have long situations of, you know, major overextension, right? When we start to get to kind of these perfect storms, you know, kind of like we had right here, right? We hit some resistance, big space between moving averages, we're going to get some sort of correction. And you can see that this correction on US steel happened. It hit, and then we pretty immediately had 1, 2, 3, 4, 5, 6 down trading days. Boom, 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 boom. Trading days downtown. So when we get to this perfect storm of space and moving average, you know, hitting moving averages, there's a couple of things that we can do here. There's a couple of things we can do. Yes, we can, let's just use X for example. Whoops. Yes, we can just buy a put option. You know, the safe-ish bet would be to say, all right, we're hitting that area. Let's just say we're at the money here, 120, or sorry, 1950-ish. So we're going to just buy kind of an at the money put. You know, a safer bet. I mean, we go out 2 weeks and we're already risking $150, and there's a really good chance we're going to take that $150 loss, right? The alternative would be go out, you know, a nice chunk, right, and go up a little bit higher, get a little in the money. So we say, hey, this thing's, you know, there's big resistance. We'll just say hypothetically at $20. I'm going to buy a $21 or a $22 put. I'm going to go out, you know, a couple of months. Now, I'm risking about $500 on this thing, $460, $470 right there on there in that area. I'm risking about $500 on the trade. It can make me a lot of money if the stock drops like crazy, but it, you know, we're taking some risk. We're taking some pretty good risk on that. So the other thing that we can do is we can try to time the market a little tiny bit. So we can either A, go with a long expiration, in the money put. It's like hard for me to even say this because I just, it's such a disaster for most people, but I want to let everybody know what the options are for things that, you know, that could be coming, right? We just have overextended stocks. We have a new administration, you know, new regulations, new taxes, new whatever. Market may hate it, right? It may hate that. And so if it does, we need to be prepared for some alternatives. Now, our regular go-to strategy is going to be very, very good for most of this. But there's a few things we can do. So in the money long-term options, a little tiny bit safer, but a pretty good amount of risk, right? The other alternative would be, let's say that US steel is hitting resistance. We've got that big space. You know, we have all those things that we say, I'm getting a little bit concerned, a little bit worried. The other thing that we can do is go with very short expirations, like 1 week or 2 weeks, right? And we can say, okay, let's pretend like US steel's, you know, big resistance is at $20, and we do something like maybe we buy a $16 put, right? A way out of the money put with a short expiration. Now all we're risking in a worst case scenario is 25 or 30 bucks, right? If we have very overextended markets, we have big spaces between those moving averages, and we're running into some major resistance levels, this might be a good trade that we can stay in for just a couple of days. Now, I know the risky folk out there are going, ooh, I love it. You know, we can take some quick trades, make some quick money, and we'll get rich overnight. It's not what this is. What this is, though, is if we see something that, you know, that kind of meets that criteria, we have just a real heavy amount of distance between even that short-term moving average, that 50 moving average, and we're hitting some pretty major resistance levels, which a lot of stock, you know, are right now. A lot of stocks are hitting some really big levels. Then we buy a short-term, far out of the money put that's cheap, 16, 15.50, right, somewhere down here. And all we're looking for is, you know, essentially this kind of a movement, right? We hit that resistance level, and for 6 days, this thing drops like a rock, right? Now, it's very difficult to call tops and bottoms in the market. I'll be the first one to say that. It's very, very difficult. But what we can afford to do with these kinds of bets is do multiples of them, right? We can take this trade. If it doesn't work and the stock goes higher, we're out $20. We're out $25. We can do another one, and we can do another one, because when these markets get, when these charts get overbought that much, and they get that far away from those moving averages, and again, it has to be stock that's not, you know, we don't want to do this with Tesla ever. We don't want to do this with Apple, right? Even though those ones do still perform and they do still behave, we want to find these stocks that are really, really extended, and they're stocks that are a little more reasonable, right? US Steel is a great example. It's making a nice run up, but, you know, hit some resistance. It's coming back down. Had some good space in there. So, you know, something like that could have been a candidate for, you know, a 4 or 5 strike out of the money put option with a, you know, 1 to 2 week expiration, where we're risking a very small amount of money. Now, if this stock drops off of, you know, $20 down to $15 or whatever, we're going to make 10 times our money on the trade, right? 10 times our risk. And that's good. And that's okay. And so these are kind of the types of option trades, buying options that I support, right? Where you take very small risks. You pay 15, 20 cents an option, 10 cents an option in some cases. And maybe we're wrong 1 or 2 times. We make 20 or 30 or $40 losses a couple of times, and then we get a $500 or $600 gain, you know, after that, right? And that's the kind of stuff that, you know, that we want to see. Those are the kinds of option trades that, you know, that I've done in the past, because you can be wrong a couple of times and make up for it very easily with one trade that works. But it's not a strategy for everybody, but it's how we can trade this market. Now, if we start to just see long-term downtrends, right? We see everything is just kind of going down and going down and going down, then just buy a long-term put, right? You can just trade that down, buy a long-term put. I don't think we have a big downtrend coming in the market. I think we have a lot of sideways activity, and I think we have some, you know, aggressive short-term corrections probably coming. And so, you know, using our regular strategy is going to work, is going to be just fine. But for those that, you know, want to be a little riskier and kind of want to give it a little bit of a shot, then that's where we have this strategy, right? Where you either buy, you know, a 3-month in the, let's call this ITM in the money put, you know, 3 or 4 months, right? Give it a lot of money or a lot of time and keep it in the money. Or we buy a 1 to 2 week, you know, far out of the money, right? 5+ strikes out of the money put, right? So those are kind of the 2 strategies that, you know, that we'll be doing a little tiny bit of in the group. We'll be sprinkling it out there, but I want to make sure that everybody kind of has some inkling and some sense of what you can do in this kind of a market. 90% of our trades will still be kind of this type of a, you know, either wait for a pullback or use a longer expiration. 90% of our trades will be that. And then we'll get assigned the stock, or we won't get assigned the stock, and we'll take the option profit, be done. We're going to always have some, you know, especially in these kinds of conditions, we're going to have some long VIX ETFs that we're holding, you know, to take advantage of the VIX coming off those lows and making a spike. But we're also going to be looking for, you know, probably 0.5% of the time we'll buy a real long-term in the money put. And from time to time we'll buy a far out of the money short-term put. If something meets that criteria, right? We have that huge space between price, that huge space, between price and between moving averages, right? 50 moving average, 200 moving average. That's an okay strategy because we're risking very little to make, pretty good money, right? To make some pretty good gains. But we can't just, the one thing that I just have to encourage everybody to think about and remember, you have to find a strategy that is divorced from your thoughts, right? If you think the market's going down, listen, I will be the first to say that there's political situations that make me lacking a lot of confidence in the market, right? Does that mean the market's going to go down? No. It means I personally, in my very limited knowledge, am not very excited about what I see coming in the future, right? Can the market go continually straight up? Absolutely. So remember, and I've said this 1,000 times, the market does not care what we think, right? Do not use this strategy. Don't say, hey, I heard about buying a 1 to 2 week option, 5 strikes out, and I'm going to put it on a stock that I think this stock has to go down. Don't think the stock has to go down. Look at the chart, right? We have to have setups. We have to have some pretty specific criteria. We need to have that big space, right? We need to have some resistance that's going to at least stop the market from going a little bit higher. And then you can incorporate some of this stuff. But don't do it. I feel like the next thing I'm going to hear is a bunch of people buying a bunch of short-term, far out of the money puts on the SPY. Don't do that. Don't do that. Let's have good reasons. SPY looks pretty good, right? It looks pretty good. But let's make sure that we have very, very good reasons to be doing what we're doing when we're buying options. Because otherwise, if we buy options without a really good reason to be doing what we're doing, it's just going to eat up our premium, and we're going to lose money on it. I really don't like buying options, but when I do buy options, this almost sounds like a beer commercial, Dos Equis, right? I don't buy options very often, but when I do, that's the kind of scenario that we're going to be looking at. And very specifically, this scenario here, right? Short term, far out of the money, cheap bets, right? Let's risk $15, $20 per contract and see if we can get a decent run out of the stock. Okay, thoughts, questions, comments. What do you guys think about that? How does that feel? How does that seem? Does that make sense? What do you guys think? Sound like a terrible idea? Does anybody want to give it a shot? What do you guys think of that? Okay, sounds like a plan. Sounds like a plan. Sounds like a plan. Glenn, nothing's happened to the VIXI strategy. We're holding on to our VIXI. We got it. Nothing's changed there. We own the VIXI. It's doing just fine for us. Lenny, been thinking about doing that pretty soon on SPY. So, again, if you are thinking about doing this somewhere, make sure, and SPY is a pretty good example here, make sure we got some good space, good space here, good space here. Gotta have both of those, right? A lot of space in there so that, if we do this, if you look at an SPY option, if we go the route of, let's see, SPY is trading at 384. Let's say we buy a 387.50 put, but we send it out there a little ways, right? Maybe like 6 months, give or take, whatever. This takes us out to May. It's going to cost us, close to $2,000 per contract. That means, and if you're thinking to yourself, I got more than $2,000 in my account, that's a $2,000 risk, and that's not one most of us want to take, but that would be kind of one way to trade this whole thing, right? Is to say, okay, I'm going to go really long term and give this thing plenty of time to go down. And then, of course, the other, if we look at this right here and we say, all right, I'm starting to think, SPY's getting a little overcooked here. Can we get a pretty cheap option on this one? I mean, it's still going to cost us a good little chunk here, but you buy a 370 strike put, a week and a half out, it's costing you $100, right? And if SPY makes a decent move there, you can make some okay money on that. So that is a good way to go. Glenn, why waste money on a wasting asset if we can make money on a market drop using VIXI? Okay, yeah, good, Lenny. Yeah, Glenn, we want to have an approach that covers kind of all of our bases. So that's why. That's definitely why we want to make sure that we're covered in a couple of different things. When we get these aggressive, and remember the other reason is when we get these aggressive movements. I mean, we have seen that SPY, and we've seen this across all the stocks, right? We get these pretty wild moves down. This took a couple of weeks to go from high 350s down to just about 320, right? I mean, it took a couple of weeks to get there, 2 or 3 weeks. But these sell-offs, even though they look pretty steady, pretty tame, pretty normal, can actually happen pretty quick. They can be pretty aggressive. They can happen over a 2 or 3 week period, 4 week period. So, but those short-term options, with some limited, SPY is pretty expensive. So even short-term options are going to be a little more expensive. But if we find some of these stocks that are really, really overcooked, think about this SRNE stock that we have, right? This thing makes a big run up. We've had some bullish positions on here, and it's been doing really well. This makes a big run up and starts hitting some resistance and starts really pulling far away from that. We get these nice cheap stocks that we can buy some out of the money options for pretty inexpensively. And we get to ride those down. But we need to make sure that we have a really extended, really overcooked market. So if I look over here at, say, Delta Airlines, right? Again, same thing as kind of Southwest. Not really an overcooked market. It's actually working on some trend. It's working on getting up there. I actually like Delta for just buying it and letting it run. But we need to have a really overextended market to be, doing this strategy that we're talking about. Okay. Any other questions, thoughts, comments? What do you guys think of that? That is how I think we need to adjust for potentially some short-term corrections, potentially some long-term corrections. That's how we need to kind of make sure we're set up and running for that. Okay, I hope that's helpful, guys. If we have no more questions, no more thoughts, no more comments, if you do, please type them in. If you don't, we'll leave it at that, and we will plan on just kind of trading the heck out of this market. For group members and everyone, we'll see you Friday morning, bright and early, for a nice, happy, good webinar. I'm looking forward to that. We have some great things to talk about with our specific trades. Thank you much, everybody. Good to see you all. Any final questions before we go? Let me know. Otherwise, we'll leave it at that. Yes, Janae, the recording will be posted for sure. Thanks, guys. Nice to see everybody. Happy to have you all on with us. Take care, guys. Have a wonderful Thursday evening. Ken, 9 a.m. Eastern time Friday morning. 9 a.m. Eastern time Friday morning. 6 a.m. Pacific, 9 a.m. Eastern. See you guys in the webinar. Take care, everybody.